Welcome back to the deep dive. Today we are tackling a company that really defines so much of the modern technological and, well, geopolitical tension. Intel Corporation, ticker INTC.
It really is the ultimate paradox, isn't it?
Yeah.
I mean, if you just step back, you're looking at a company that was the undisputed giant, the king.
Absolutely.
Yet it somehow managed to be the biggest operational loser in the single largest technological boom in recent memory.
Yeah.
I'm talking about the generative AI wave.
Which they just almost completely miss.
Almost completely.
Yeah.
And yet at the same time, that exact same company is now emerging as maybe the single most critical industrial asset for the national security of the entire Western world.
That tension is just incredible. The operational failure on one hand versus this massive strategic necessity on the other. It's what makes this whole story so explosive.
Exactly. We're looking at Intel today, Saturday, November 29, 2025, and it is without a doubt the most complex, frustrating, and potentially explosive investment case in the S&P 500.
We all watched it. This icon just shed, what, nearly $100 billion in value, all because of years of just failure to execute.
And now it's clawing its way back from what really looked like the brink of total irrelevance.
And the market is just reacting so violently to every little piece of news. We saw the stock close yesterday, November 28, at $37.07.
And then boom. After hours, some geopolitical news hits, a partnership announcement.
And the price just surges up to roughly $40.78 almost instantly. That just tells you the sensitivity here. It's a tinderbox.
It confirms that Intel's price isn't really dictated by quarterly earnings anymore. Not in the traditional sense.
No.
It's driven by executive announcements, by cheap PS Act money, by geopolitical whispers. The old valuation model is just broken.
So the ultimate question we're trying to answer today, connecting all the sources we have, is this. Are we looking at a classic cigar butt value play, a cheap asset left behind?
Or is this a fundamental government-backed turnaround of a strategic, truly irreplaceable national asset?
And to give you, our listener, a clear roadmap of where this is all going, our analysis, which is grounded in, normalized future earnings and strategic value, suggests the intrinsic value range for Intel is somewhere between $50 and $60 per share.
Which implies pretty significant upside. And critically, we're going to show you precisely why the margin of safety here is, well, it's unprecedented. And that's thanks to a very unique new shareholder who fundamentally changes the entire risk profile.
That's our mission today. We're conducting a holistic audit looking at operational health, strategic direction under the new leadership, and of course, intrinsic value. We're going far beyond the headlines to understand the true core of the sovereign chip. Part 1, Chapters 1 to 3. Business, Management, and Financials. Chapter 1, Business Understanding. Okay, let's start with the business itself. Because if your mental model of Intel is still stuck in, say, 2015...
You have to just throw it out completely. That company, the monolithic CPU maker, doesn't really exist anymore.
The entire strategy has fundamentally shifted. It's been bifurcated under something they call IDM 2.0.
That acronym, IDM 2.0, Integrated Device Manufacturer 2.0, that's central to understanding the new company. The old Intel, the old IDM, designed, built, and sold its own chips. That was it.
One vertically integrated profit machine.
Right. But this new IDM 2.0 aggressively splits the company into two distinct almost competitive engines, Intel Products and Intel Foundry.
And that separation of the Foundry, that seems to be the strategic masterstroke here.
It is. It's operating with its own P&L, almost like it's already a separate company. And its focus is radically different. Its job is to sell manufacturing services to external clients.
Including, theoretically, direct competitors, like a Qualcomm
or even NVIDIA, if they choose to use the platform. That willingness to sell capacity to rivals is the big bet. Intel is now competing with TSMC, not just building chips for itself.
And if they pull it off, they create this whole secondary stable revenue stream that's not tied to the, the volatile PC market.
You can see this new structure in their four primary revenue streams. Yeah. And they're all telling very different stories right now.
Okay, let's start with the first one. The Client Computing Group, or CCG. This is the traditional cash cow, right?
It's the cash bedrock, and it's been surprisingly resilient. In Q3 2025, it pulled in $8.5 billion. That's up 5% year over year.
And that stability, the sources say, is coming from the Core Ultra series for PCs and laptops.
Directly from that. It's catching the lift from this nascent but really important AI PC cycle. Integrating AI capabilities right on the chip means they can command a better price.
Okay, so CCG is solid. Then you have the most challenging segment, data center and AI or DCAI.
This is where the pain has been. This is where they hemorrhaged market share to AMD's EPYC processors and, more disastrously, just got left in the dust by NVIDIA's platforms.
So what's the news there?
Stabilization. That's the key word. They managed $4.1 billion in Q3 2025. A lot of that is still legacy Xeon processors, but the Gaudi AI accelerators are starting to fight for some relevance.
Stabilization is the best news they've had from that division in years.
It really is.
All right, number 3 is the big one. Intel Foundry. You said it generates a lot of revenue, $4.2 billion in Q3, but it's a financial black hole. How does that work?
Because it is brutally capital intensive. I mean, we are talking about massive immediate depreciation costs hitting the income statement.
From the new fabs, the ones in Ohio and Arizona.
Exactly. They're equipping them with incredibly expensive machinery, especially those EUV extreme ultraviolet lithography machines. They are paying the sticker price and the depreciation now before the revenue from those foundry customers has really started to flow.
So the costs are front-loaded.
Massively.
Yeah.
And the fourth stream is Network and Edge, NAX. It delivered about $1.6 billion. Kind of the quiet, stable segment.
The boring one.
The boring but necessary one.
Yeah.
It serves telecoms, 5G, industrial IoT. It's not a huge growth driver, but it produces stable margins.
So let's pivot to the technology, because you said the entire thesis really hinges on one thing.
It does. It all comes down to the 18A process node. This is the bet the company element,
Yeah.
and it is entirely binary. There's no middle ground here.
Okay, so we're moving past the old monolithic chips. They're transitioning to chiplet architectures,
Yeah.
like Lego blocks for silicon, Panther Lake, Clearwater Forest, and all that.
Right. But the critical point isn't just the design, it's the manufacturing process itself. What is 18A?
What is 18A?
It's Intel's attempt to leapfrog the competition, specifically TSMC's 3-nanometer and their future 2-nanometer nodes. The A stands for angstrom, which is a tiny unit of measure.
So they're promising a density and an efficiency that's actually better than what TSMC currently offers.
That's the promise. And it's binary because if 18A works at yield, meaning they can produce good chips without massive waste, and it actually leapfrogs TSMC, Intel wins.
Big. And if it fails...
If the yield is poor, or if TSMC just maintains its lead, the entire turnaround thesis collapses. The latest internal reports, for what they're worth, suggest progress is on track.
And this technological ambition feeds directly into what you called Intel's most unique asset, its sovereign status.
Precisely. The value here just transcends market efficiency. Intel is the only US-based manufacturer that can produce these leading-edge logic chips at scale. Period.
And that creates the security of supply value proposition.
It's everything. For customers like the Department of Defense or for the U.S. cloud giants like Amazon and Microsoft, choosing Intel Foundry isn't just a cost decision. It's an insurance policy.
It's a guarantee that their most sensitive supply chain is on U.S. soil with U.S. labor under U.S. law.
You got it. Intel is basically pitching itself as the fortress of the Western semiconductor supply chain. They might charge a premium for that insurance, but in a world like this one, that premium is becoming non-negotiable.
This geopolitical angle has completely redefined the competitive landscape, hasn't it? It's turning rivals into, well, partners.
Symbiotic partners? Just look at NVIDIA, the AI kingmaker. They are Intel's fiercest rival in the data center.
And yet they made a stunning $5 billion investment in Intel in September of this year.
A $5 billion investment. So you have to ask why. Why would the richest, smartest company in AI make such a huge bet on its struggling rival?
It can't have been just about the 18A process.
It wasn't, though that's a nice bonus. It was driven by Intel's world-class advanced packaging technologies, specifically Foveros and EMIB.
Okay, explain that. NVIDIA needs these to stitch their massive GPU chips together.
Exactly. Their new chips aren't one big piece of silicon anymore. They're collections of smaller chiplets, and they need to connect them to meet this unprecedented demand for bandwidth and low latency in AI.
And EMIB and Foveros are the technologies that do that. What's the difference between them?
EMIB, that's embedded multi-die interconnect bridge, is like a super high-speed bridge embedded in the chip substrate. Connects two chiplets side by side. It's mature, it's reliable.
Okay.
But Foveros is the real leap. It's 3D stacking. It allows Intel to literally stack chiplets on top of each other like floors in a skyscraper.
Which drastically reduces the distance signals have to travel.
Right. And that boosts bandwidth exponentially while cutting power consumption. Those are the two absolute must-haves for cutting-edge AI accelerators like NVIDIA's 8 series.
So NVIDIA basically needs Intel's packaging expertise to keep scaling its own products. That $5 billion is a massive validation of Intel's packaging moat.
It is. Even if their foundational silicon process temporarily lagged, their packaging is world-class. And of course, all of this is backstopped by the government.
The CHPS and Science Act.
That's Intel's biggest financial safety net. It's not just promises of grants anymore, it's converted into actual equity. In August 2025, the U.S. government acquired a direct 10% equity stake in the company.
10%. That is the ultimate confirmation of the too critical to fail status. It's a signal to the entire market and especially to short sellers that this is not a purely market-driven company anymore.
It's a protected strategic national asset. Chapter 2, Management Evaluation. So much of the current story is defined by the seismic change in leadership. We have to remember the narrative around Pat Gelsinger's tenure.
He was the returning son, right, the visionary engineer, the Intel lifer, brought back to save the company.
Running on, let's be honest, a lot of engineering hubris.
Yeah.
And a promise that he could fix the process nodes because he was Intel culture.
And his tenure just ended so abruptly in late 2024. The stock had collapsed, the losses were mounting. It was a shock. The engineering messiah was out.
And he was replaced by a financier. That must have sent tremors through the whole company.
It did, and in steps the new CEO, Lip-Bu Tan, appointed on March 12, 2025, and his background is completely different.
It's crucial. He's less of an engineer and more of a Buffett-style capital allocator, an operator. He was the former CEO of Cadence Design Systems.
And under his watch, that stock appreciated by a staggering 3,200%.
That's the track record. It speaks to a ruthless commitment to capital efficiency and shareholder returns, which is exactly what Intel's old culture resisted.
So his crisis response has been clinical.
Clinical is the perfect word. Immediate, focused on survival, not on vanity projects. First, the cost management was ruthless. He implemented a plan to deliver $10 billion in annual cost savings.
Which included that painful, culture-breaking 15% reduction in headcount.
It did. And second, capital security. Instead of just running to the expensive debt markets, he orchestrated those massive strategic deals with the U.S. government and NVIDIA. He brought in cash without the high interest strings attached.
He also changed the tone. He recognized that Wall Street hated the old management's roadmap hubris.
Promising tech that didn't exist yet.
Yeah.
Tan instituted what he calls radical transparency. They now issue very conservative guidance, focusing only on stabilization and progress. They're trying to underpromise and overdeliver.
Rebuilding credibility?
1 quarter at a time. And this discipline shows up in their wartime capital allocation. No frivolous M&A. All available capital is laser-focused on one thing.
Completing the Ohio and Arizona fabs to bring 18A online.
Exactly. And we're also seeing a smart divestment strategy. The spin-off of non-core assets like the FPGA unit, Altera. That's a perfect example of what Tan does.
Selling off parts of the empire to save the castle.
Precisely. Streamlining the focus back onto high-margin, leading-edge logic and foundry services.
Now, we have to address the stark reality for investors, especially those who relied on Intel for income. This new stewardship has caused a lot of short-term pain.
A lot. The dividend was suspended in 2024. The yield is basically zero. There are no active buybacks. This is purely a capital appreciation play now.
And we also have to talk about the dilution. That government investment meant issuing new shares.
It did. Roughly 433 million new shares were issued to the U.S. government. So yes, that slightly dilutes existing shareholders, but you have to see it as a trade-off.
A necessary trade-off for the immense security and risk reduction that the government backing provides.
Absolutely. Which brings us to the most visually terrifying metric for any financial analyst looking at Intel right now, the return on invested capital, or ROIC.
It's abysmal. It's deep in negative territory, somewhere between -10 and -13.5%.
If you see that number in isolation, you run for the hills. But you have to understand the mechanics of it. The formula is return divided by invested capital.
And the denominator, the invested capital, has just ballooned because they've sunk tens of billions into those new factories.
Billions. In land, construction, and especially those incredibly expensive EUV machines for 18A.
And because of accounting rules, the depreciation on all that stuff starts immediately, even before the factories are making money.
So your numerator, the return, is crushed by massive startup costs and depreciation expense.
So the ROIC dilemma is temporary, assuming they execute.
That's the whole bet. The value proposition here is entirely on mean reversion. Once those new factories are fully operational, probably in 2026 or 2027, the return will surge, and the ROIC should normalize back to the industry standard of, say, 15 to 20%.
Yeah.
That's the bet TAN and the U.S. government are making.
Chapter 3, Financial Health. Okay, let's get into the hard financials. Intel is still a massive company. The market cap is hovering around $193.47 billion.
Which is huge, but when you compare it to its trillion-dollar peers like NVIDIA, it's clearly being priced as a show-me story.
The market is applying a huge discount for execution risk.
A huge one. And the revenue trends, they really confirm this deep cyclical trough and the start of a U-shaped recovery. They peaked in 2021 at around $79 billion during that pandemic PC boom.
Then collapsed. The bottom was in 2024 at $53.1 billion. That was the point of maximum pain.
But the recovery is underway. Q3 2025 revenue came in at $13.7 billion, which beat expectations. And crucially, the guidance for Q4 suggests continued stabilization. The downturn has officially bottomed out.
Now, the margin story is probably the most watched metric. It's the health indicator for the factories.
Historically, Intel commanded gross margins over 60%. That was the monopoly price.
And that collapsed to a crisis level of, what, 32.66% in 2024?
It did, but here's the green shoot. The Q4 2025 guidance projects gross margin expansion to 36.5%.
That seems like a small jump.
It seems small, but it is monumentally important. It is the first hard, tangible evidence that factory utilization is improving, and critically, that the yield issues with the newer process nodes are finally being resolved. When gross margin expands, the stock can breathe.
And TAN's cost-cutting is starting to show up on the bottom line.
Absolutely. 2024 saw a staggering $12 billion operating loss in the first 9 months. But in Q3 this year, they returned to a positive operating income of $683 million. The hemorrhage has been stopped.
It shows you how powerful the operating leverage can be once revenue just stabilizes.
Exactly. But now we have to talk about the Achilles heel for many investors, free cash flow. And we have to be honest.
Intel is a cash incinerator right now.
It is the company's greatest weakness. Negative $15.6 billion in FCF in 2024. The trailing 12 months figure is still a negative $13.5 billion.
So the key insight here is that Intel is not funding its own growth.
Not at all. Its massive capital expenditures, all those fabs, are being funded entirely by external capital, debt, government grants, and that NVIDIA equity injection.
Which is obviously unsustainable long term.
But it's mitigated by the fact that they have this immense, unprecedented external backing. And that brings us to the balance sheet.
The debt is high, right? Around $53 billion.
It is high, but it's heavily buffered by a massive cash position of $29.3 billion. And that huge liquidity runway is thanks directly to the NVIDIA and U.S. government cash infusions.
And the ratios look okay?
They confirm that near-term bankruptcy risk is basically off the table. Debt to equity is manageable at 44%, and the current ratio is robust at 1.60. They have the resources to get through this investment cycle.
So when we try to value this thing, trailing PE is obviously useless because of the negative earnings.
Completely useless. The whole thesis relies on future normalization.
So if earnings get back to the analyst consensus of maybe $2 to $3 per share by 2027,
which assumes 18A is working and margins recover,
then the current price of around $37 implies a forward PE of just 12 to 18 times, which is structurally cheaper than AMD or NVIDIA.
Exactly. That's the cheap thesis on future earnings power. Our discounted cash flow model has to rely on that future Foundry success.
Wait a minute, though. You just told us they are a cash incinerator, losing over $13 billion in FCF a year. How can we possibly justify a $50 to $60 target today? That's up to 50% upside, based on a promise of future execution that they have historically failed to deliver.
That is exactly the right tension to apply to the model. We justify that $50 to $60 base case by adjusting 2 key variables. First, the earnings normalization is based partly on external contracts, like NVIDIA's, and government guarantees, which de-risks the execution element a little.
Okay, a little. What's the second more important variable?
We use a much lower cost of capital.
The WACC, the weighted average cost of capital.
Right. We're using a relatively low WACC of 8.22%, and this is critical. We are reflecting the lowered risk premium that Intel now commands, specifically because of that strategic U.S. government backing.
So the government's equity stake is like a political put option?
That's a perfect way to put it. It
Yeah.
gives the company a safety net that pure market players just don't have.
Yeah.
And that lower risk allows us to justify a higher present value for those future cash flows.
Okay, so with that context, let's break down the full valuation range. What's the bear case?
Bear case. The Foundry fails. 18A yields are a disaster. The company defaults back to being just a legacy PC business. In that scenario, the valuation collapses to the liquidation value of its assets, somewhere around $20 to $25 a share.
That's the floor. And the base case, the one you just defended, is our intrinsic value of $50 to $60 per share.
Right, and the bull case. Intel executes flawlessly, becomes the TSMC of the West, captures massive AI packaging revenue, and gets the ultimate prize.
Apple as a customer.
Apple is a major customer. In that scenario, the market gives them a much higher multiple, and the value could push past $85 a share.
Like and subscribe to the Stock Analytics AI. For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment. Intel is still very much a battleground stock, and the analyst community really reflects that division. The average one-year price target is sitting right around $36.50.
Which is right where the stock has been, so it's a firm hold consensus.
It is. The market is demanding proof, not promises. Analysts will not upgrade this thing to a strong buy until they see hard, undeniable evidence that the 18A node is yielding in high volume. Until then, it's an execution risk story.
But the media narrative, the overall tone, has definitely shifted dramatically.
Oh yeah. Through 2024, it was funeral watch. Now it is firmly in the Phoenix Rising camp.
And there are two massive bullish catalysts driving that sentiment shift. The first was that watershed $5 billion NVIDIA investment.
That was huge. If the company with the highest market cap and the smartest capital allocation in AI is putting $5 billion into Intel, it's a massive validation of the technology.
Especially the packaging and the roadmap.
Right. And the second catalyst, which is what fueled that after-hour surge yesterday, is the persistent, powerful rumor that Apple might use Intel's 18AP node for some of its low-end chips in 2027.
Which would be the ultimate validation. If Apple chooses Intel over a competitor, even for a slice of their business, it signals that Intel is technologically back.
It's also been fascinating to watch how the market processes bad news now. Take that recent rumor about a TSMC trade secret lawsuit.
Right, that surfaced just before Black Friday, alleging some kind of proprietary info theft.
The market just shrugged it off. In fact, the stock rose nearly 10% on the news.
How does that happen?
Because investors interpreted the lawsuit not as a sign of Intel's guilt, but as a defensive move by TSMC, a sign that the king is genuinely worried about Intel's progress. They saw it as confirmation that 18A is moving faster than expected.
The technical indicators also confirm this big trend reversal. The stock is now trading comfortably above both the 50-day and the 200-day moving averages.
And the 200-day is way down at $25.76. This convergence means we have officially seen the golden cross.
For our listeners, the golden cross is when that short-term average crosses above the long-term average.
And technically, it is one of the strongest possible signals confirming a definitive reversal from that deep bear market that plagued Intel from 2023 into early 2025. The trend has changed.
And you have to mention the short squeeze dynamics here. That strategic floor put under the stock by the government and NVIDIA is basically a political insurance policy.
It is. Short sellers who are betting on bankruptcy have been wiped out. Short interest is contracting rapidly, which just contributes to these violent upside moves on any good news.
Chapter 5, Ownership Structure. The ownership structure of Intel is it's unique in the tech world. And it's essential to understanding the risk profile. It doesn't behave like a purely public company anymore.
It really doesn't. It resembles a strategic defended asset. A semi-nationalized entity is the perfect term for it.
The ownership is heavily concentrated in what you'd call strong hands, right? People who aren't easily spooked by a bad quarter.
Exactly. You've got the huge passive institutions like BlackRock, Vanguard, State Street. They hold over 20% combined.
But the real concentration is with the two strategic owners. First, the U.S. government.
They are the largest single shareholder now, with a strategic 10% stake, about 433 million shares that they got through the Cheech Ass Act grant conversion.
And their role isn't operational. They're not telling Lip Bhutan how to run the factories.
No, but they are intensely active in strategic defense. That 10% stake virtually guarantees that no foreign entity can launch a hostile takeover of America's primary chip maker.
It stabilizes the long-term future. And second, the strategic partner, NVIDIA, with its $5 billion stake.
Which is not a passive investment. It's a commitment from a key customer whose own future success relies on Intel's advanced packaging coming online.
So all this concentration directly reduces the effective float.
It does. The float is the number of shares actually available for trading day to day. And when the float is constrained, any surge in demand.
Like the news yesterday.
Exactly. It causes these violent, exaggerated price spikes because high demand meets very low supply. It adds to that asymmetric upside profile.
We're also seeing a return of insider confidence. The new CEO and board have significant equity incentives tied to the turnaround.
And critically, we haven't seen any significant panic selling from insiders in late 2025, which suggests that internally they have faith in those 18A test results. Chapter 6, Risk Assessment. Okay, let's do a full SWOT analysis here. Strengths, weaknesses, opportunities, and threats.
Let's start with strengths, the foundation of the fortress. Intel commands the largest semiconductor manufacturing capacity in the entire Western Hemisphere. That physical footprint is just priceless in a deglobalizing world.
And their packaging leadership is still a world-class moat. Foveros and EMIB are the reason NVIDIA is a partner. That ability to stack chips vertically is a real technological lead.
Okay, on to weaknesses. The primary one has to be the company's decade-long execution history.
Trust is so low. They have such a painful history of missing deadlines and process node failures. The entire turnaround depends on Lip-Bu-Tan overcoming this ingrained legacy.
And there's also the legacy culture, that monopoly hubris you mentioned.
Yeah.
Scrubbing that from middle management is a huge multi-year effort.
And finally, the structural reality of the cost structure.
Well,
Manufacturing in the U.S. is just more expensive. Higher labor, higher regulations. They will probably never achieve true cost parity with their Asian rivals.
now for the opportunities. The potential upside. The biggest single catalyst would be the Apple pivot.
Oh, absolutely. If those rumors are true, and Apple chooses Intel Foundry for even a portion of their low-end chips in 2027, it is the ultimate external validation that 18A is a world-class technology.
Secondly, the massive growth opportunity in AI inference. As AI models move off the cloud and start running locally on AI PCs and laptops.
Intel is perfectly positioned to capture that value at the edge, where NVIDIA doesn't dominate.
And the management opportunity. A Foundry spinoff.
Separating the capital-intensive manufacturing business from the high-margin design business could unlock massive shareholder value. It would let the Intel product side trade at higher, software-like multiples.
Finally, the threats, where the cliffs are highest.
Technological leapfrog is relentless. TSMC is moving aggressively to 2 nanometer and 1.6 nanometer. If Intel's 18A is just as good as what TSMC already has, that's not enough to win back major customers. They have to leapfrog, not just catch up.
And there's the long-term threat to the by86 moat from ARM and RSCV. If Windows on ARM ever achieves perfect emulation.
Intel's key software switching cost advantage just evaporates. The CPU could become a commodity.
And let's address the most sensitive paradox of all, geopolitical risk.
The trade war threat was huge this year, but the delay in U.S. tariffs on semiconductors stabilized the market a bit.
But future implementation could trigger painful Chinese retaliation. China is a massive market for Intel's client chips. If Beijing implements delete A policies and bans Intel, the revenue hole would be massive.
And then there's the high-stakes, highly sensitive Taiwan crisis paradox. A military crisis in Taiwan would be an immediate, catastrophic disaster for the global economy.
It would halt 90% of advanced chip manufacturing.
But financial models, in their cold calculation, are pricing Intel as the necessary Western hedge. So, paradoxically, any escalation in the Taiwan Strait tension would be interpreted by the market as a massive, perverse, bullish driver for INTC.
Because the scarcity value of the only US-based leading-edge manufacturer would just skyrocket. That insurance premium is now baked into the valuation. Chapter 7. Conclusion. Okay, so we've analyzed the dramatic business bifurcation, the surgical leadership change, the U-shaped financial recovery, the shift in market sentiment, and the unique government-backed ownership structure. Let's synthesize all of this into a final outlook.
The bull case really rests on 4 main pillars. First, it's too critical to fail. That 10% government stake in the NVIDIA partnership have basically removed the bankruptcy tail risk. It's a government-backed infrastructure play now.
Second, the leadership upgrade. Lip-Bu-Tan is focused ruthlessly on profit and capital allocation, which is exactly the antidote Intel needed.
Third, technology validation. The NVIDIA commitment and those persistent Apple rumors strongly suggest that 18A and the packaging tech are real and they're desired by the world's most advanced companies.
And fourth, you're buying at the cyclical low. They're at the bottom of the PC and margin cycle. As those new fabs fill up, the operating leverage should just drive unprecedented profit surges.
The bear case, however, still warns that this could be a value trap. Despite the cost-cutting, the company is still burning billions in cash. If the turnaround gets delayed by even a couple of years, further dilution is highly likely.
There is also the structural disadvantage. We said it before, manufacturing in the U.S. is just more expensive. They may never achieve margin parity with TSMC, which structurally limits their profitability.
And finally, the specter of irrelevance.
Yeah.
In a world dominated by GPUs for AI, the CPU risks becoming a commodity, relegating Intel to a secondary role.
So based on this comprehensive audit and recognizing that risk mitigating effect of the government floor, we are restating the fair value estimate for Intel between $50 and $60 per share.
Which offers upside potential of, 25 to 50% from the current trading range?
Yeah.
The execution risk is very real, but the downside is so profoundly protected that it gives the investment an asymmetric risk-reward profile.
So our final outlook is neutral to bullish. Intel is no longer just a stock, it's a geopolitical instrument of immense strategic importance. It has a huge runway for growth, but only if this new management can finally overcome decades of internal resistance and failure.
And the provocative closing thought for you, the listener, is this. The giant has not only woken up from its slumber, it has been conscripted into mandatory service. So does a strategic asset, backed by the U.S. government, deemed vital to the entire Western supply chain, deserve a valuation multiple based purely on market efficiency or on its irreplaceable strategic insurance value to the modern world.
Like and subscribe to Stock Analytics AI. And don't forget, for just $4.99 a month, you get access to over 500 deep dive videos on all the S&P 500 stocks. The NASDAQ 100 is coming next. Plus, you can request members-only deep dives. Join us and get well-informed quickly.
And finally, a required disclaimer. This analysis was generated by an AI system drawing on the provided source material for educational purposes only and should not be considered financial advice. We urge you to conduct your own comprehensive research or consult with a qualified financial advisor before making any investment decisions.